What if I told you one simple investment could potentially turn $100,000 into over $3.5 million? And no, it's not crypto, options, or some hidden loophole. It's 5 index funds from Charles Schwab. Boring? Maybe. Effective? You're about to see just how much. Today I'm breaking down what happens when you invest $100,000 into Schwab's 5 top index funds. I'll show you how they could potentially turn $100,000 into over $500,000, $2 million, and in the end, I'll show you a Schwab index fund that has the potential to turn that investment into a $3.5 million valuation while paying over $20,000 in monthly dividends. Now, before we dive into the numbers, let's take a second to talk about why Charles Schwab and how I picked these 5 funds out of literally hundreds of options out there. Let's start with Schwab itself. Charles Schwab has built a rock-solid reputation as one of the most trusted, low-cost investment platforms in the world. Their index funds have no loads, no commissions, and some of the lowest expense ratios you'll find anywhere. For long-term investors, that means more of your money stays invested, compounding for decades. But it's not just about fees. Schwab offers broad diversification, transparent fund construction, and a track record of performance that rivals the biggest players in the game. Whether you're starting with $100 or $100,000, Schwab makes it easy to get in and stay in for the long haul. So how do I pick these 5 index funds? I followed a simple but powerful process. First, I looked at dividends, not just the current yield, but how fast those dividends have been growing over the past decade. Then I factored in historical share price appreciation to see how much long-term value each fund has delivered year after year. I also paid close attention to how each fund is structured. Are they market cap weighted or fundamentally weighted? Do they automatically rebalance? These features might sound technical, but they actually tell you a lot about how a fund reacts during different market cycles. My goal is to strike that perfect balance between growth and income. I focused on funds that consistently pay dividends, grow those dividends over time, and still offer solid capital appreciation. And I didn't want to be limited to just US stocks, so I made sure to include both international and domestic exposure. Finally, I added one fund that's a bit different, a target date fund that automatically adjusts its risk as you approach retirement. It gradually gets more conservative over time without you having to do a thing. All 5 of these funds are easy to access, cost-efficient, and built for hands-off wealth building. Now, before we jump into today's topic, quick shout out to the sponsor of this video, Moomoo. If you've been investing through your bank or one of those bare-bones apps, this might be a good upgrade. Moomoo is a free platform that gives you real-time market data, advanced tools, and zero-commission trades all in one clean, easy-to-use app. New users right now can get up to $1,000 in NVIDIA stock just for opening an account and making a qualified deposit. The more you deposit, the more NVIDIA stock you can earn. It starts at $20 for $100 and goes all the way up to $1,000 in stock if you deposit $50,000. That's on top of their usual promos. You still get 8.1% APY on uninvested cash, and yes, that cash is FDIC insured up to $1 million. You also get free access to Morningstar research, analyst ratings, and premium news sources like the Wall Street Journal and Bloomberg. So if you want to check it out, the link is in the description and pinned comment. Even if you're just curious, the promos alone make it worth a look. Thanks again to Moomoo for supporting the channel. Now let's get into today's video and kick things off with number 5 on my list, a globally diversified index fund that spreads your money across developed economies around the world. The Schwab International Index Fund with the ticker symbol SWISX. Now, if you've ever felt like investing overseas sounds complicated, this fund makes it simple. Instead of trying to pick individual stocks in foreign markets, which, let's be honest, most of us don't have the time or expertise for, SWISX gives you instant access to over 700 companies from developed economies around the world. Europe, Australia, Japan, it's all in there. It invests in both growth and value stocks across sectors like banking, manufacturing, technology, and healthcare. The fund uses full replication, which means it owns virtually every stock in the index, giving investors broad, hands-off access to the world's most developed economies. Its sector exposure is remarkably well-balanced. Financials make up about 22%, industrials are just under 19%, healthcare is at 11%, and tech comes in close to 10%. The rest, industries like consumer goods, communication, and energy, all add smaller slices to the pie. That kind of balance really helps, because if one sector takes a hit, chances are another one is holding steady or even pulling ahead. And when you zoom into the top holdings, it's a lineup of household names: SAP, ASML, Nestle, Novartis, Roche, companies with real staying power. An important thing to note here is that the top 10 make up just 12 to 13% of the fund. That is super diversified. No one company can drag your entire investment down, and that's exactly what you want when you're thinking long-term. Also, the fund comes with a super low expense ratio of just 0.06%, making it one of the most cost-effective ways to access international stocks. Over the past year, SWISX has returned 15.02%. Over 5 years, it was up 44.11%, and across the past decade, it's delivered a total return of 39.11%. These aren't sky-high returns, but they're steady and supported by both dividend payouts and global equity growth. So let's plug in the numbers here. What happens if you put $100,000 into this fund? Right now, SWISX has a dividend yield of 2.66%, with dividend payouts growing at an average of 4.64% per year. Its share price has been steadily climbing too, with an average annual return of 3.79%. So let's say John invested $100,000 and the fund manages to maintain the same performance in the future. After 1 year, his portfolio could potentially reach around $106,450. Stick with it for 10 years, and it might grow to roughly $188,669. After 20 years, the investment could be valued at $364,200. And after 30 years, it has the potential to reach $720,726 in valuation. By then, the annual dividend income might land somewhere around $22,861. That's close to $1,905 per month. Looking at the full 30-year projection, John's initial $100,000 investment would add a total value of $620,726. Out of that, $339,709 comes purely from capital appreciation, while $281,018 results from reinvested dividends. Next, at number 4, we have the Schwab Fundamental International Equity Index Fund with the ticker symbol SFNNX. It takes a different approach than traditional market cap weighted funds. Instead of focusing on the size of a company's stock price or market cap, this fund selects and weights stocks based on real business fundamentals, things like cash flow, dividends, and total sales. It's designed to capture the actual economic strengths of companies. Launched in 2007, this fund follows a benchmark called the Rothi Fundamental High Liquidity Developed ex-US Large Index. Sounds complicated, but here's the simple version. It invests in large companies across developed countries outside the US, and it's constantly adjusting. If a stock gets too expensive compared to its fundamentals, it gets trimmed back. If a company starts performing better, it gets more weight. Right now, SFNNX holds a massive lineup of 943 companies, and the beauty is no single stock takes over the spotlight. The top 10 only make up about 11.61% of the entire fund, so your money stays spread out and balanced. Names like Shell, Samsung, Total Energies, and Toyota sit at the top, but even they hold just small slices of the pie. Other familiar players like HSBC, Nestle, Roche, Santander, and BP round it out, all staying well under 1% each. And when you look at sectors, the focus leans toward the traditional side. Financials and industrials take the lead, followed by consumer cyclicals, materials, and energy. There's still a solid slice of tech and healthcare, but overall, the fund leans more toward value, which can be a good thing when markets get shaky. With nearly $3.6 billion in assets and a turnover rate of just 12%, SFNNX is both popular and surprisingly efficient. It doesn't trade too often, which helps keep things stable, and even with its more hands-on, fundamentals-first strategy, the expense ratio sits at just 0.25%. Not the cheapest, but still very reasonable for what it delivers. As for the performance, over the past year, the fund returned 16.26%. Over 5 years, it's up 66.54%. And across the last decade, the total return has hit 49.6%. Now here's where it really starts to add up. Right now, SFNNX offers a dividend yield of 2.87%, which is higher than what you'll find in a lot of broad market funds. And even better, those payouts have been growing at about 5.34% per year over the last decade. And then there's the average share price growth of 4.34%. So let's say John put $100,000 into this fund. After 1 year, his portfolio could reach $107,210. At the 10-year mark, it might grow to $203,106. After 20 years, he'd be looking at around $424,751. And if he stayed invested for 30 years, that single investment could grow into a $917,326 portfolio. That includes $452,437 in capital appreciation and $364,889 from reinvested dividends, adding a total of $817,326 in value over the original investment. And if John were living off income at that point, his projected annual dividends would be $32,480 or about $2,707 per month. Solid return, but not $1 million return. In a couple of minutes, I'll show you an index fund that reaches the $1 million goal, and after that, I'll show you a Schwab index fund that has the potential to turn a $100,000 stake into a $3.5 million portfolio that pays over $20,000 in monthly dividend income. Up next, let's see how the U.S. total market stacks up. At number 3, we have the Schwab Total Stock Market Index Fund with the ticker symbol SWTSX. This fund gives you full exposure to the entire U.S. stock market. That means it doesn't just focus on the giants, it includes large cap, mid cap, and small cap companies across every sector. If it's publicly traded in the U.S., chances are it's in the fund. SWTSX tracks the Dow Jones U.S. Total Stock Market Index using a full replication strategy, which simply means it actually owns all the stocks in the index, not just a slice. In short, with this fund, from tech to energy to healthcare, you're basically owning a piece of the whole U.S. economy in one simple investment. It's been doing this since 1999, and over the years, it's become a go-to choice for anyone who wants broad, no-nonsense exposure to the American market, all with the simplicity and low costs that Schwab is known for. SWTSX is basically a snapshot of the U.S. economy, and its performance proves it. In just the past year, it's grown by 16.98%, with momentum picking up as the market recovered in mid-2025. Zoom out a bit, and the numbers get even more impressive. Up 91.83% over the last 5 years and 178.74% over the past decade. And it's not just strong, it's efficient. The fund has one of the lowest expense ratios out there at just 0.03%. Plus, with a turnover rate of only 2%, it sticks with its holdings, keeping things stable and hands-off for long-term investors. The fund holds a massive 3,036 different stocks, which gives you serious diversification. Now, even though the top 10 names take up about 31.91% of the portfolio, the rest is spread across thousands of companies, giving you a really wide base. Tech leads the way, making up about a third of the fund, 32.73% to be exact. Then come financials at 14%, consumer cyclical stocks at just over 10%, and healthcare, communication, and industrials all sitting between 8 and 10%. The rest of your investment gets spread across everything from real estate to energy and utilities. At the top of the list, you've got the usual heavy hitters: Nvidia, Microsoft, Apple, and Amazon. Meta, Alphabet, Berkshire Hathaway, Tesla, all the big names are there. But with thousands of other companies alongside them, you're not just betting on a few tech giants, you're buying into the entire U.S. market story. Right now, SWTSX has a dividend yield of 1.14%, and those payouts have been growing at an average of 5.8% each year. Combine that with long-term annual share price growth of 11.09%, and you've got a strong mix, perfect for long-term investors. So let's say John invested $100,000 in this fund and left it untouched. After 1 year, his portfolio would grow to about $112,230. Stick with it for 10 years, and it might reach $310,404. After 20 years, we're talking $931,410, and if he stays the course for 30 years, that investment could potentially grow to a massive $2,740,225. So the total value added over that time could reach $2,640,225, with about $2,552,155 coming from share price growth alone and another $88,071 from reinvested dividends. So that's the U.S. total market. But what if you narrowed the focus, investing in America's biggest, most dominant companies? That's exactly what the next index fund is all about. The Schwab S&P 500 Index Fund with the ticker symbol SWPPX. It's one of the most trusted vehicles for passive investors looking to gain exposure to America's largest, most dominant businesses. This fund tracks the S&P 500, which includes 504 of the largest and most influential publicly traded companies in the U.S. It's been around since 1997, and with an expense ratio of just 0.02%, it is one of the cheapest ways to invest in America's top-tier companies. If you're looking for simplicity, broad diversification, and consistent performance, this is about as straightforward as it gets. SWPPX is powered by a portfolio of giants, the kind of companies that shape the U.S. economy. Tech leads the way, making up 34.36% of the fund. That's no surprise, considering how much innovation and growth are driven by the tech sector. After that, you've got financials at 13.67%, consumer cyclicals at 10.54%, followed by communication services, healthcare, and industrials. The top 10 holdings make up about 36.35% of the fund. That includes heavyweights like Nvidia at 7.29%, Microsoft at 6.99%, and Apple at 5.79%. Amazon, Meta, Broadcom, Alphabet, both Class A and C shares, Berkshire Hathaway, and Tesla round out the list, each holding a solid chunk. Now, that level of concentration might sound high at first, but these are dominant, cash-rich businesses with massive global reach, and they're the backbone of the modern economy. Performance-wise, SWPPX has been nothing short of impressive. In the past year alone, it's gained 17.39%. Over 5 years, it's up 97.93%, and across the last decade, a massive 196% return. Now let's look at what that kind of long-term growth could actually mean for your money. Right now, SWPPX comes with a dividend yield of 1.13%, and those payouts have grown at an average of 5.02% per year. On top of that, the share price has averaged 11.66% annual growth. So if John invested $100,000 into SWPPX after just 1 year, his portfolio could grow to around $112,790. Fast forward 10 years, and it might be worth $324,894. After 20 years, it could reach $1,016,791. And if he stays invested for the full 30 years, that one-time investment has the potential to grow into a massive $3,122,653. Most of that growth, about $2.9 million, would come from the share price alone. Reinvested dividends would add another $72,870. And by year 30, the portfolio would be generating around $4,303 per year. Great growth, solid returns. But if you're looking for dividend income down the line, this next one takes the crown. At number 1, we have the Schwab Target 2045 Index Fund with the ticker SWYHX. This fund is built for people planning to retire around the year 2045, but honestly, anyone with a long time horizon can benefit from how it's structured. What makes it unique is that it's designed to change with you. Right now, it leans into growth, but as the years go by and 2045 gets closer, it slowly shifts towards more conservative income-focused investments. You don't have to do a thing here. It handles the adjustments automatically. It's made up of other Schwab ETFs, so from day one, you're diversified across different asset classes, sectors, and even countries. Stocks, bonds, real estate, all wrapped into one easy fund that evolves as you move through different stages of life. Looking at the fund's historical performance, it delivered a 13.51% return over the past year, 55.51% over 5 years, and 103.77% over the last decade. That's solid, considering it balances growth and stability. The fund currently manages $886.16 million in assets, maintains a low expense ratio of 0.08%, and has a 14% turnover ratio. Right now, SWYHX is still in its growth phase, meaning it's heavier on stocks than bonds. Most of the fund is made up of the Schwab U.S. Large Cap and International Equity ETFs, giving it strong exposure to big companies in the U.S. and around the world. It also includes small caps, emerging markets, and real estate, all focused on growth. The bond portion is still relatively small, which makes sense for a fund designed for people retiring around 2045. Even though it's in its growth phase, it has a solid dividend track record. Right now, it has a dividend yield of 1.92%, and those dividends have been growing at a rapid pace, with a 10-year CAGR of 13.49%. Combined with an average annual share price return of 8.21%, this fund brings both strong long-term growth and rising income to the table. If John invested $100,000 into SWYHX after 1 year, his portfolio could grow to around $110,130. In 10 years, it could be valued at $275,268. In 20 years, he might be looking at $878,233, and after 30 years, that one-time investment could potentially reach a valuation of $3,569,252. The total value added to the portfolio? A massive $3,469,252. Of that total, $1,509,912 would come from dividend reinvestment alone, and $1,959,341 from capital appreciation. As for the dividends, by the 30-year mark, this portfolio could be paying out around $261,012 per year, or about $21,751 per month in income. Hey, if you made it this far, make sure to check out Moomoo. Join the 26 million users worldwide already on it. They're running a promo right now where new users can get up to $1,000 in NVIDIA stock depending on how much you deposit, plus 8.1% APY on your uninvested cash, FDIC insured up to $1 million. If you want to take advantage of the offer, just click the link in the description or pinned comment below. It's free to explore, and the rewards stack up fast. Click the video on the screen to find out how to make $7,000 per month with only $20 a week.